AT&T has announced it will resize its dividend after the Warner Media spin-off is complete. On top of that, recent volatility in the overall stock market and relatively high valuations have made investors wonder if a stock market crash is coming. In the dividend investing world, AT&T is loved by many dividend investors, seeking income because of its high dividends and long, reliable dividend history. If you're one of those investors holding AT&T, it will have likely shocked you. And when the sky is falling, you want dividend stocks you can count on. That begs the question how to protect your dividend portfolio in both these cases. Today I will show 5 resilient and recession-proof dividend-paying companies to protect your portfolio with. The first stock on this list is Microsoft. This is not typically a dividend stock that would come to mind as a recession-proof stock. But hear me out. A dividend stock that you can rely on during bad times needs to have stable and predictable revenue, even when the sky is falling. Microsoft used to be very reliant on the sale of PCs and their Windows software, a largely discretionary expense that is likely to be dropped by consumers when they have less to spend. What's worse, it was not recurring income and Microsoft had to convince its customers every time to purchase the products again. Not anymore. Microsoft reports through 3 segments: productivity and business, which includes Office 365, LinkedIn and App Dynamics, intelligent cloud, which includes Azure and other server products, and more personal computing. This includes Windows, Xbox and search advertising. Most of these products are now subscription-based: Office 365, Azure, LinkedIn, Xbox content and services, and include a large portion of the revenue of Microsoft. More and more businesses become dependent on the cloud, and as one of the biggest cloud platforms, Microsoft Azure benefits greatly from that trend. Even in bad times, a company cannot just unplug its systems from Microsoft Azure or stop using Microsoft Office 365. These support essential business processes a company cannot do without. So just like grocery stores are essential for the livelihood of people and thus make them recession-proof, Microsoft is essential for businesses. And do you think people will just stop looking for jobs with LinkedIn or stop gaming when a recession hits? I don't think so. To back this up, let's look at some data. Microsoft has the ultimate dividend safety score of 99, has a stunning growing revenue trend and has very little debt. And with a payout ratio of 29%, there's plenty of room to grow the dividends. During the last downturn in March 2020, Microsoft dropped 26%, less than the 32% of the S&P 500. During the recession of 2007-2009, Microsoft dropped 48% compared to the 55% of the S&P, and their revenue only dropped 9%. Important for us dividend investors, the dividend was maintained during 2007-2009 and was even raised with 10% during the pandemic in 2020. Remember that during the recession of 2007-2009, Microsoft was a vastly different company with a lot less predictable revenue than they have now. For fiscal year 2021, Microsoft is expected to grow its earnings with 35% and 7% in the year after. Those are some serious growth numbers for a company this size. Number 4 on this list is Procter & Gamble. This is probably no surprise to anyone. With its many household brands that are often in the number 1 or number 2 spot of their respective category, which are mostly essential products that are always needed, Procter & Gamble is one of the ultimate recession-proof stocks. P&G has one of the highest dividend raise streaks out there, with 63 years of consecutive raises, so this includes multiple recessions and downturns. Procter & Gamble too has the ultimate dividend safety score of 99 and has just increased their dividend with 10%. I don't know about you, but I love companies that are able to raise their dividends for such a long time and increase it when you most need it, in uncertain times like these. In March of 2020, P&G only dropped 19% compared to the 32% of the S&P, and in 2007-2009 dropped 36% compared to the 55% of the S&P 500. P&G might not be the sexiest stock out there, but it still grows its revenue over time and is an important stock to hold to protect your dividend portfolio. With a very well managed and low debt to equity ratio and a payout ratio of 61%, it shows why P&G is such a safe pick. A dividend portfolio can't only hold high-flying companies. You also need stable juggernauts like P&G. But despite its size, P&G is expected to grow 10% in fiscal year 2021 and 6% in 2022. That again is pretty good for a company that operates in a lot of saturated markets. Before we move to number 3 on this list, first a bit about me and this channel. I'm Tom from the Dividend Attitude Show, and on this channel I make in-depth videos on different stocks, different stock battles, top 5 videos like this one, and once a month an update on my personal portfolio. And then, in the number 3 spot, NextEra Energy, ticker NEE. As a utility, they have very predictable recurring revenue from the vast amount of regulated contracts they have with governments, which have built-in escalators as well. A big difference with your everyday utility is that NextEra Energy is a frontrunner in renewable energy, which makes them very resilient for the future. NEE is another dividend stock with the ultimate dividend safety score of 99. In the recession of 2007-2009, they only dropped 31% in price, again compared to 55% of the S&P 500. In March of 2020, they did drop 31%, so just a bit less than the S&P 500. The sales of NextEra Energy are slightly uptrending, well-managed debt to EBITDA ratio of 4.5, which is good in a capital-intensive sector like utilities. And during the recession of 2007-2009, their revenue only dropped 9%, and their dividend was still increased. In fact, they have been raising their dividend for 25 years in a row now. NextEra is another dividend stock that recently increased its dividend with 10%, and also did so with 12% in 2020. You gotta love these predictable companies. With a yield of 2% and a dividend growth rate of 12%, NextEra adds some extra income and nice dividend growth. Personally, I would like the yield to be more towards 2.5 to 3%, but that is very hard to get for an excellent company like NextEra. In second place is a company I also own myself, which is Pepsi. Pepsi is much more than just their name brand drink and owns brands like Frito-Lay, Quaker, and much more. And combined, those brands have the largest market share in 4 of their top 5 geographical markets, according to a 2016 investor presentation. Do you stop eating chips or breakfast during a recession? I don't. Pepsi has a dividend safety score of 93, which is not as high as the maximum of 99 of the previous 3, but still very high. During the recession of 2007-2009, they only dropped 35% in price compared to the 55% of the S&P. But get this, their sales only dropped 0.5% during that time. I guess I'm not the only one still eating chips during recessions. In March of 2020, Pepsi dropped 29%, so a bit less than the 32% of the S&P. Pepsi has a dividend growth streak of 48 years and raised the dividend with 7 and 5% in 2020 and 2021. With a payout ratio of 70%, this is a bit on the high side, but I'm not too worried about that. Pepsi also has stable and slightly uptrending sales to support their dividend. The only thing is that their debt to equity looks high, but their net debt to EBITDA is fine, so I'm not worried about that either. Pepsi does offer a bit of a higher yield than the others in this list at a near 3% and dividend growth rate of 8%. If you want to know why I picked Pepsi over Coca-Cola, check out the battle between Coca-Cola and Pepsi, which is now suggested. And then the number 1 on this list. A company I've recently made a second battle video about. Costco. Costco is a grocery retailer, well actually more like a wholesale warehouse where you can shop for deeply discounted grocery items. This industry is famous for its razor-thin margins and intense competition. Costco is a little bit different though. Looking at the gross margins, Costco has one of the lowest in the industry and much lower than Walmart and Kroger. But Costco has something that the others don't. Predictable recurring revenue because of their 100 plus million members worldwide that pay to shop for prices that are just 15% above wholesale. And that shows in their revenue uptrending and growing substantially each year. Costco also has very well managed debt and a low debt to equity ratio of 0.55. This results in another maximum dividend safety score of 99, and with a payout ratio of only 32%, it is easy to understand why. What happened with the share price during the March 2020 drop? It is hardly visible on the graph here, because they only dropped 9% compared to the 32% of the S&P. In the 2007-2009 recession they did drop 38%, but that is still a lot less than the 55% of the S&P. Just like Pepsi, their sales only dropped 1.5% during that period. As a dividend investor, I also want to know how their dividends perform during recessions. Costco also does not disappoint there. They recently raised their dividend with 13%, and this is after they already paid out the $10 per share special dividend in November. That tops the raises of all the other dividend stocks in this list. The only issue I have is that their current yield of 0.8% is quite low. But with expected earnings growth rates of 10 and 8% in fiscal years 2021 and 2022, there's a lot of room to grow. So there you have it. 5 different picks that are recession-proof and could act as good safe replacements for AT&T. Most of these stocks are currently not really undervalued. So if you are looking to pick up some undervalued stocks, check out episode 51, These 5 dividend stocks are on sale, which you can watch by clicking here on the right video. I'm off, until next week.